Most retirees lose sleep when the market drops, but here's what's interesting. Our clients at Modern Capital often sleep just fine, even during major crashes. Why? Because they're using a bucket strategy they can be confident is built to get them through some of the worst times in the stock market. I'm Josh Maley with Modern Capital, and in today's video, I'm going to show you exactly how our three-bucket approach works, why it provides both financial protection and psychological peace during volatility, and how it's designed to handle even the worst-case scenarios retirement can throw at you. Chapter 1, the retirement nightmare most people face. The scenario that keeps retirees up at night goes something like this. A hypothetical retiree, we'll call him Robert, retires with $2 million, needs $75,000 a year, and follows the traditional approach, 60-40 portfolio split between stocks and bonds, and he's withdrawing 4% annually. Everything seems fine until the market crashes 30%. Suddenly, Robert's portfolio drops to $1.4 million, but he still needs $75,000 to pay his bills. So he's forced to sell stocks when they're down, locking in those losses permanently. When those stocks eventually recover, Robert doesn't benefit because he already sold them at the bottom. This is called sequence of returns risk, and it's the single biggest threat to retirement security. It's not just about market crashes, it's about when they happen. A crash in year 1 of retirement can be catastrophic in ways that a crash in year 15 isn't. And here's what makes it worse. The supposed safety net in Robert's portfolio isn't doing its job either. That 40% in bonds, bond funds have averaged 1% to 2% over the last 10 to 15 years, barely keeping pace with inflation. They don't have a maturity date. They don't have guaranteed principal. The bond funds that are supposed to provide safety can drop significantly in value. We saw this in 2022 when bond funds fell right alongside stocks. Robert thought he had protection. He didn't. So what does the fear of this scenario drive? Panic decisions. Robert pulls everything out of the market, moves to cash, and never gets back in. What could have been a temporary 20% portfolio hit becomes a permanent 40% loss when you factor in the recovery he missed. And I saw this exact situation happen in 2008. Practically every call I got was someone who had thought they could handle a downturn but was calling because they wanted to get out. Chapter 2, the three-bucket strategy explained. This is where the bucket strategy changes everything. Instead of lumping all your money into one portfolio and hoping diversification saves you, we break it into 3 distinct buckets, each with a specific job. Every dollar needs a purpose. Bucket 1 is cash, immediate emergency funds. Bucket 2, it's your protected income bucket, designed to fund approximately 20 years of predictable income. And bucket 3 is your growth bucket, left completely untouched for 20 years to compound. The beauty of this structure is that each bucket operates independently. When the market crashes, your growth bucket can drop 40% and it doesn't matter because you're not touching it for 2 decades. Your income is protected in bucket 2, and your emergencies are covered by bucket 1. This isn't just a different way to organize your money, it's a completely different philosophy. Traditional portfolios are built around asset allocation, percentages of stocks and bonds that get rebalanced periodically. The bucket strategy is built around cash flow timing. When do you need each dollar, and how do we make sure it's there? Chapter 3, Bucket 1, Cash for Emergencies. Bucket 1 is simple but essential. 6 to 12 months of living expenses in cash or cash equivalents, you can access immediately. High yield savings, money market, whatever is liquid and stable. This money earns minimal returns, but that's not its job. Its job is to be there when the air conditioner breaks, or when you need a new roof, or when those unexpected medical bills show up. When the market drops 30%, you're not panicking about how to pay next month's bills. You have immediate liquidity. That psychological benefit alone is worth having this bucket in place. Chapter 4, Bucket 2, Protected Income. This is where the strategy gets really interesting. Bucket 2 is designed to fund your lifestyle for the next 15 to 20 years without exposing you to market risk. Now, I want to be clear. This bucket doesn't have to be one specific product. It can be CDs, it can be bond ladders, it can be money markets, or even annuities. It just has to be something we know isn't going to lose money. Now, that said, many of our clients choose a fixed indexed annuity for at least part of this bucket after we walk them through the options, and here's why. Fixed indexed annuities offer a floor at 0%. You can't lose money in down years. During the 2007 to 2009 crash, when the S&P 500 fell 56% from peak to trough, annuity holders saw 0 losses. Not reduced losses, 0. On the upside, they average 4 to 6% historically, with caps that might be as high as 7 to 10%. But those aren't returns you should be relying on. This is lower than what you'd expect from stocks over the long term. But maximum long-term growth isn't this bucket's job. Compare that to what bonds have done over the last decade. You're looking at 1 to 2% average returns, and in many cases, negative real returns after inflation. You're still paying fees on that part of your portfolio as well. With a fixed indexed annuity, we can cap the floor at 0 and potentially average 4 to 6%. That's a better return than bonds with no downside risk. I think that's a win for our clients. Now, the elephant in the room, commissions. Yes, annuities pay commissions. I'm not going to dance around that. But those commissions don't come out of your pocket or reduce your account value. They're paid by the insurance company from their own reserves. Your $500,000 investment stays $500,000 on day 1. Chapter 5, Bucket 3, Growth for the Long Term. Bucket 3 is where wealth actually builds. This bucket stays fully invested in equities and remains completely untouched for 20 years. Here's what should give you confidence. No 20-year period in the S&P 500 history has ever produced negative returns. Not during the Great Depression, not during the 2000 tech crash, not during 2008. When you give stocks 20 years, market volatility transforms from a threat into an advantage. This bucket can drop 40% in year one of your retirement, and it just doesn't matter. You're not touching it. It has 2 full decades to recover and compound. The March 2009 market bottom saw the S&P 500 at 676. By 2015, it had fully recovered to previous highs, a 6-year recovery period. Bucket 3 has 20 years. That's more than enough runway. This is also your inflation hedge and your legacy bucket. Stocks are the only asset class that consistently outpaces inflation over long periods. And when you don't touch this money for 20 years, the compounding is extraordinary. If bucket 3 starts at $1 million and averages 8% over 20 years, you're looking at roughly $4.6 million. That's money that funds the back half of your retirement and potentially leaves a significant inheritance to your kids, all while bucket 2 handled every dollar of income along the way. Chapter 6, stress test, retiring into the 2008 crash. Now let's put this through the worst case scenario. Imagine a couple, Tom and Linda, who retire in 2007 with $2 million and need $75,000 per year beyond their Social Security. Using the 3-bucket approach, they have $50,000 in bucket 1 for emergencies, $800,000 in bucket 2 generating protected income, and $1.15 million in bucket 3 for growth. In 2008, the market crashes. Bucket 3 drops from $1.15 million to $690,000, a 40% decline. But here's what happens. Their $75,000 annual income continues flowing in from bucket 2 without interruption. They're not selling anything. They're not watching their income source shrink. They're taking a trip. Because of the market turmoil, that trip actually got cheaper. They're seeing grandkids. They're living in retirement while the market sorts itself out. Bucket 3 sits untouched, recovering over the next 6 years, and then continuing to grow for another 14. Now compare that to Robert from the beginning of this video. Same crash, same portfolio size, but Robert's using a conventional 60-40 portfolio and withdrawing 4% annually. He's forced to sell stocks at the bottom every single year from 2008 through 2010 to fund his lifestyle. Those shares, they're gone forever. When the recovery comes, he benefits less because he has fewer shares. And psychologically, Robert is a wreck. He's refreshing his account every morning, wondering if he needs to go back to work. And Tom and Linda aren't even thinking about the market. Chapter 7, the psychological advantage. After 25 years of working with retirees, here's what I can tell you. The math matters, but psychology matters more. You can have the most mathematically optimal portfolio in the world, but if you panic and sell at the bottom, it's worthless. Everybody says they can handle a downturn. Everybody says they're a long-term investor until they're tested, and then they're not. The bucket strategy works because it aligns with how humans actually think and feel about money. Knowing your income is predictable and protected for the next 15 to 20 years eliminates the panic when news shows red and talking heads predict doom. Our clients don't worry about crashes because they know their bills are covered. Bucket 2 provides income. Bucket 3 is untouched. There's nothing to panic about. There's no emotional decision to make. That's by design. If you're 55 to 70 years old and you have $1 to $5 million in investable assets and you're thinking about retirement over the next few years, this is the window where getting your structure right matters most. A crash in year 1 can derail an entire plan. Having a strategy that accounts for volatility before it happens means you never have to make an emotional decision with your money. Complexity creates anxiety. Simplicity creates confidence. And our clients like it that way. If this strategy makes sense to you and you want to explore whether it's right for your situation, I'd encourage you to visit our website or schedule a call with our team at Modern Capital. We specialize in working with clients who have $1 to $5 million in assets and want a retirement plan built around confidence, not complexity. We work virtually with clients across the country. Our link is in the description.